You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors.
Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today I'm joined by Nathan Sosa, a tax advisor here at Hall CPA, to discuss what it means to have dealer status when selling a property. This is a heavily audited topic in recent years. So if you're curious about what factors the IRS will consider when selling a property to help you ensure you pay capital gains taxes and not ordinary income taxes, you'll love this episode with Nathan. All right. Well, we are here with Nathan Sosa. Nathan, you have joined us in the past on episode 267, back again to talk about a new topic, talking about things like being a dealer, the Winthrop factors. We'll get into what that is in just a little bit. But before we do, would you be able to give our listeners just a little bit of background of who you are?
For sure, Ryan. Yeah, thanks for having me on again. So I am been in Oklahoma City for like the past 2 decades, honestly. So definitely an Okie at heart. It's getting real hot out here. I don't even know if it gets warm in Minnesota, Ryan. So I'm not sure what you're experiencing at the moment. But yeah, love talking tax, love talking real estate, honestly. Anything that comes to that's like basically investing or anything like that, like involves tax strategy. It's definitely like a fun topic for me, voracious readers. So like always reading tax court cases. And also, as you can see, can't really see the podcast. You can't see the books behind me, but like all the books behind me as well. So definitely something like that. Also trying to find sleep. We got a 9-month-old right now, so that's lots of fun. But now, like as I tell everybody, not lots of sleep. But yeah, it's a little bit of background on me.
Awesome. Well, thank you for that. And for those of you listening, Nathan is kind of a typical tax nerd, is what he has said of himself. And I would absolutely agree. There's a few of them in the world, and he is certainly one of them. So he is a good person to hear some technical things like what we're going to talk about today, which is kind of talking about things that we in the profession would call the dealer status. And we'll kind of get into, again, another phrase that is out there. We're going to evaluate the Winthrop factors. And that comes from a tax court case where they've kind of outlined some various factors, 7, I think, in particular, of factors that help someone who is, for example, a owner of real estate. How might the court determine whether a individual selling a property is essentially considered a real estate investor or someone who is a dealer who is then going to be seen as more of like a flipper. And there's some tax differences there, some very specific tax implications between those two and how you're seen. So Nathan, can you just kind of give us a broad overview of what are the main differences there as far as the tax aspects, the various percentages, but also just like, yeah, other than the tax implications, is there anything more that people should really be considering here other than this tax difference? But yeah, walk us through some of that.
Yeah, absolutely. So like one of the first things to think about is that if you are an investor, the largest tax you can get on a sale of your property will be 23.8%. Let's think about it like you'll send a quarter of it to the IRS, right? Highest you'll ever do if you're an investor. However, if you are considered a dealer, then the tax rate you could be subject to, if you're going to be subject to the highest rates, right? Got a great property, great appreciation on it, and now you're selling it. You could be subject to the highest ordinary income rates, which is 37%, and self-employment tax, which means that on that sale alone, you could be potentially subject to basically a 50% tax, right? So we're looking at basically a 25% difference in the money you get to keep versus the money that you're sending to the government, right? So trying to delineate between these lines is incredibly important, right? And sometimes the line is like, sometimes it's really clear, right? Sometimes you're really far on the investor side, makes sense, right? No big deal there. Or you completely fall on the flipper or wholesaler side, right? So no big deal. Sometimes we kind of land in the middle, and that's where we can really find value for clients and find the opportunity to take advantage of certain aspects and have forward planning and forward thinking, right? That's the goal here, is to be thinking and looking forward to how we can help our clients save on that 25% rate right there.
Right. Yeah, there's huge tax differences as far as the tax rates, the various taxes that someone's going to be impacted by between whether you're just a real estate investor when you sell your property, right? You're thinking long-term capital gains potentially, plus net investment income tax. So that's kind of how we got to the 23.8%. And then the 52% that Nathan's talking about, is that highest federal income tax rate of 37%, plus that, assuming all of it's, potentially subject to self-employment tax, that additional 15.3%. So that's kind of how you get to the 52.3% there. So that's a huge difference, right? More than double between these two differences. So this has huge impacts for any of you looking to sell. We're in a market where people are considering selling, or maybe some of you are just holding on until rates change, maybe next year. Well, you're going to be wanting to think through early on before a sale, hey, what might I need to be doing or protecting myself from some pitfalls here to make sure that when I do sell this next year or coming up this year, to make sure that I don't fall into that 52% and maybe more likely stay into that 23.8 if I were ever to be audited. So Nathan, let's just kind of keep continuing on here. Like, what is an investor in real estate? Let's just kind of start there. Like, how do we start to make these distinctions?
Yeah, an investor is someone like the tax code and tax court cases kind of looked at someone that's like, if you are an investor, you're holding a property, you're right, you're looking for cash flow, you're looking for rental income, right? That's what you're looking on. You're looking for rental income and appreciation, right? Like obviously, like we're all diversifying our portfolios, like we invest into. Some people do stocks, some people do bonds, some people also want to diversify and put themselves into real estate, right? They want to get the appreciation on real estate, whatever that ends up being over time, while getting cash flow at the same time. And as we talk about all the time, the beautiful tax benefits that we get alongside it, right? So that's an investor, right? Now, on the quote unquote flip side, no pun intended, is the flippers, right? People who are buying a property, whether it's, it's a dump or it's almost ready to market, but you could sink in another $10,000 to $15,000 and you might be able to get 30, 35 out of it, right? So like something like that, like someone who's like, hey, I'm going to work on this for 6 months and then sell it after 6, right? That's someone who's going to be seen as a dealer, right? Especially like you're working on multiple properties all at once, or you do it multiple times a year. That's someone who's going to be seen as a quote unquote dealer, right? So like, that's like, I would say those are the two clear ends of the spectrum, right? But what are the people who, like, let's say a real estate agent who they do sell properties every once in a while, right? But it makes sense. Or it makes sense. Or they held it for a year and a half. They held it for 2 years, right? Now it's like, okay, well, now it feels a little muddier. It's like, well, I sell real estate as a living, even though I don't personally own it, but also I'm selling my properties kind of like, I would say maybe infrequent basis, maybe not frequent, but like, what does that look like? What does that mean? Am I considered a dealer now? And it's like, that's where we get into that ambiguity of, essentially is like what the tax code asks us is like, is this what's quote unquote called inventory or held primarily for sale? Or is this going to be a capital asset, right? As the tax code defines it. And tax code basically says, hey, everything's a capital asset unless you're holding it primarily for sale in a trade or business, right? And that's actually defined. We love talking about tax court cases on this podcast because you guys will go read them, surprisingly. And I thought I was the only one out there. But one of them is called Mallet, right? It's actually a Supreme Court case back in the old 1960s. So been good case law for a long time, and basically states where the Supreme Court says, hey, Code Section 1221, right? That is what defines capital asset. They say it is basically, it's like you hold this for of principally or of first importance, right? So like essentially, what was your original intent when you purchased this property? That's kind of like what we have to decipher when we're looking at these kinds of aspects.
Yeah, there's a lot to unpack here, and that's where we're going to continue to dive into is how do we continue to help you as a listener determine, is this a capital investment where when I sell it, it's at that maximum of say 23.8%. And just a comment, we're not looking at state income tax. We're just looking at federal for our discussion today. But also then diving into, okay, what are the factors where the courts have come out and said, hey, these are the factors that made a distinction and made these people either win, kind of continue to hold their position that it was, yes, a capital asset, versus where maybe they lost and they actually were determined to be considered a dealer. And that had massive tax savings, kind of like we've talked about right at the beginning. So Nathan, let's just start to talk about what does kind of start to help us draw distinctions. We know that this is a pretty muddy area as we start to make these distinctions, but let's just start walking through a big picture. What are some of those distinctions to help the listener think through, I'm a dealer or I'm not?
Yeah, so this comes from, like, as Ryan's kind of mentioned at the top of the podcast, there's a factor test, right? And whenever we have factor tests in tax, we are able to help our clients find value, because that means we've now landed into a place of ambiguity. The tax code even is like, there's nothing that's like, right? It's like one of the favorite things that, like, if you ever talk to a CPA, they might say it depends, and that probably frustrates all investors a whole lot. They're like, well, I want a straight answer. Well, it's not always straight, but there are ways we can get to answers, right? And that's with these kinds of factor tests that tax court uses. And this set of factors are called the Winthrop factors, right? And so they've been heavily used in case law for basically since 1969, basically. So very important. But yeah, so number one, the first Winthrop factor that is viewed is the nature, and also like going back real fast, is that technically none of these factors they all hold equal weight per the tax courts, right? So they should all hold equal weight. However, I'll identify the ones that actually, like some courts have said that this actually weighs more heavily than the other ones, even though they're supposed to essentially be the same way. But we'll talk about that here in a little bit. So factor number one is, and this is one of the heavier ones, is the nature and purpose of the acquisition of the property and the duration of ownership, right? So if you purchase a property, right, and you immediately, let's say you buy land, and you immediately start developing it, subdividing it, putting down roads and improvements, we're getting it ready for a sale for someone to residential lots or something like that, then you're going to end up being seen as a dealer, right? Like that's like the 100% example. That's happened time and time again in tax court, right? So if like you purchase it and immediately start working on it, and then even if like, let's say you hold it for 2 years, but then you start working on it, the tax court's going to go back and ask you, is like, what was your principal reason for doing this, right? So like, why did you do this? You know, there's one of the big court cases was in Winthrop, for example, was like, or basically like they acquired the property for inheritance and they never used the land. All of a sudden they started subdividing it and selling the land almost immediately. And so the court was like, you're not holding this for investment, right? That's not an investment property. This is a dealer type property. So you are going to be subject to ordinary income rates here.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Whole CPA, we've worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode.
Yeah, and one thing I'll just comment on before Nathan continues to go on, the Winthrop factors that we're talking about is from a court case. That's where we're talking about this. This is like a kind of further back, like Nathan said, back in the 60s. So this has become a little bit of a standard for CPAs and taxpayers like you thinking through what things are the IRS going to evaluate. And from there, we've kind of seen additional court cases to kind of help fill in some of these main topics. So Nathan, if you just want to continue on as far as, you know, the other 7, continue on, man.
Yeah, absolutely. So factor 2 is the nature and extent of effort to sell said property, right? So basically like you're looking at, should this be inventory, right? Like, what are you doing here? Like, how are you calling people up and saying, hey, are you interested in buying a property, right? Are you calling brokers saying, hey, are you looking to acquire anything right now that you want to resell? Are you advertising it, right? Are you listing it? Like how, and sure, like as an, like you might be asking yourself, well, as an investor, I listed my property on Zillow, or I got a real estate agent, right? It's like, you can have those kinds of things, but how aggressive are you, right? Did you go get 3 brokers, right, who are both listing your property? And well, I don't think you can do that, but like, are you being aggressive in like how you're trying to get someone to get your property out of your hands into someone else's, right? How aggressive are you being with that? There's no actual like explanation for why this one is important, but like it's come up a lot in tax, right? So it's come up a lot. So going back to Winthrop real fast is like the taxpayer didn't advertise, right? They didn't advertise at all, but they were a licensed real estate broker actually. So they were seen as being the solicitors themselves, right? It's what they did as a business. Tax case called Paulus back in 1996. The taxpayer sold the land with the agreement. The taxpayer would then, after they sold it, would perform the development work under a completely separate contract, right? So in one space, they sold the land and then they said, we don't own land anymore, but we'll develop it for you now, right? So that's one example for like, not one of the major ones, but definitely one of them, right? And then factor 3, this is probably the most important one of them all. This is by far the most important. This is what the Fifth Circuit Court has definitely emphasized, and other courts have also emphasized, is the number, frequency, and continuity of sales, right? And so even then, this is like, I keep saying that like this is important stuff, but there's never like, I just want to say there's never going to be anything that's like 100% clear. It's always going to be facts and circumstances based per you, the investor or the flipper situation, right? So the number frequency of sales is super important, but basically it's like, how often are you selling houses, right? How often are you doing these things? Are you doing 32 sales a year? Are you doing 200 sales a year? Are you a large syndication and like you're doing multiple sales a year? You're selling 450, 60 lots over 18 years? Are you selling 42 lots in a 2-year period, right? Like, how often are you doing this? Like, how many times, how many deals are you doing? And if it's like, one a year, it depends on your circumstances. You could be seen as like, maybe it takes you that long to renovate the property. In that case, you might be seen as a dealer. But if it takes you 1 year and then you hold it for 2 more, right? Like, I want to see if I get some rental income, but I can't. So now I'm selling it. Maybe that's not frequent enough, right? There's times, and I think we'll get to this later, but there's been times where even one sale has like shown that you are a dealer. But this is something that the tax court definitely highlights and like likes to look through. Like, for example, going back to Byram, one of the successful cases out there, the court stated that 22 sales over a 3-year period were substantial. They were not sufficiently frequent or continuous to compel an inference or intent to hold the property for sale rather than investment, right? So even though they were selling the lots over a period of time, they were not like definitely, I think it was more of a like, hey, yeah, you did a lot of sales. However, this wasn't something that happened continuously on a regular basis that you were looking for it, right? Like a flipper might like, I want to do 5 deals a year. I have to do that so I put food on the table, right? It's like, okay, cool. That makes sense, right? And suburban realty, right? Sale of 244 lots over 32 years, right? That's basically 8 sales a year or something around there. That means you're going to be basically, you're doing about 8 deals a year. There's a high chance that you're going to be seen as a dealer just based on these tax court cases, right? And then Paulus, right? That's another successful one where someone was viewed as an investor. They had 8 sales of properties over a 10-year period. So basically they were doing like almost 1 a year, but they were still successful because they weren't seen as frequent, right? They were still not seen as frequent or substantial. And so it's like, comes down to that frequency and substantiality standpoint, right? It's like substantial is basically more looking at it from a like, yeah, this could be a lot of sales. Like it could be a lot of sales, but like what's like, and then like going back to Byram, what's the frequency? How often are you doing it? How often are you trying to advocate for the sales? Like, is it coming to you or are you going to look for it? So that's factor 3, probably the most important one.
So one comment I just want to make is that someone listening to this might be like, oh, are you saying I can't have any sales? Whenever you have a sale, yes, it comes with a evaluation. Might an IRS agent or a tax court evaluate you as a dealer? Yes, that you need to consider that. But at the end of the day, Nathan and these factors, we're not saying that you can't sell a property, right? Yes, it comes with a teeny bit of risk, but there's a lot of things to consider. So if you're a real estate investor and you're like, hey, I've held this property, it hasn't worked, it's been a year, right? I have certain clients where it's, hey, they bought a short-term rental and they held it for a year plus. They didn't get the revenue they wanted. Things didn't turn out. They had a much bigger renovation than they expected, whatever it is. And now they're like, hey, can I sell this? Yeah, nothing from my conversations with them have ever indicated any sort of intent of like, oh, I'm just going to flip and sell, right? So I just want to comment on that and kind of pause as we get through these first 3. You need to consider a lot of things. That's why we're going through these, just to kind of bring it back. But I do just want to highlight, yes, you can sell property. It's not an automatic red flag just because you sell property. So Nathan, continue on as you go through these.
Yeah, and to follow up on that, like I've had clients who they bought what they thought was a really good short-term rental, and it was a really good short-term rental. And then someone came down the road and was like, I want to live in your short-term rental full-time. Here is $200,000 over asking price. Well, I mean, you're not going to say no to $200,000 over what you bought it for, right? So it's a deal of a lifetime. You're going to take that 10 times out of 10. That doesn't mean that this property is going to turn you into a dealer, right? So you're still an investor. You're just an investor who happened to have one of the best deals like that. You got your appreciation right then and there at that point in time instead of waiting over a long period. So that's like, so totally like those kinds of people can be seen as investors, not dealers, right? That's why it's muddy. So like, that's why we're going to try and like, with a tax professional or yourself, try to find ways to get these factors on your side, right? It's like, you might win all of them, right? Maybe you lose 2 out of the 7, potentially. As long as you can win 5, or you can win, like even though there's not a clear line, you win 4 or 5 of these factors, that's a good fact pattern for you in the case of an IRS audit, in the case of any IRS correspondence, right? That's going to be the goal here. So that's why we're walking through this, so you guys can have the knowledge and be able to look at these yourselves and determine, ask yourself, am I a dealer? Am I an investor? How does that work? There is a lot of bad information out there, right? There are people who tell real estate agents, hey, if you're just a real estate agent and you claim real estate professional status, then you are going to be seen as a dealer. And that is not the case whatsoever. I will say that, and we'll say that strongly, is that if you are a real estate agent and you're just selling properties that you do not own, then your rental income is not going to be subject to self-employment tax, right? It's like, that is something that I've heard a lot of times from clients, is that like, if you claim reps, now your income is going to be subject to self-employment tax. That's not correct, right? Your real estate agent income, your commissions, sure, subject to self-employment tax, but those sales that you are doing personally as an investor, right? So long as like you are not doing it frequently, you are not doing it substantially, right? Maybe it's just once every few years, right? And like, you just like, I want to get out of this market, get into a new one, or got equity built up and I want to put a larger down payment on to get a larger high scaler as short-term rental or long-term rental somewhere else. That's an investor right there, in my opinion, right? So factor 4, the extent of subdividing, developing, and advertising, right? So if you're subdividing, grading, rezoning, installing roads, utilities, you're probably going to be seen as a dealer on that type of property, right? So like, if you are doing all that kind of stuff, like, it's going to be hard to prove capital treatment for you here, right? It's going back to that 23 versus 52%. And so like, that's something we're going to have to take a look at and see like, hey, like, you can make the property more saleable for sure. Like, you purchase property, like you want to renovate the bathrooms or something like that. That's okay. But like, if you are hardcore going to like subdivide, rezone, do a lot of different stuff, there's a chance that your sales could be subject to the dealer status, right? And so like, that's happened multiple times in tax court cases, right? And of course, been called Van Sickle, right? The taxpayer got contracts for drainage, streets, and sewers for one parcel on submission for the plans of the improvement and subdivision of other parcels, and then they were undertaken to protect the zoning of that property. The court found that like, hey, yeah, you were doing this so you could eventually sell the property. And so this is not pure investment motive, right? You didn't purchase this just for the appreciation, just for someone else to come develop it, right? And lease it out to them. It's like, this is a case where you are going to be viewed as a dealer in this standpoint, right? And so it's like something to always consider when you're thinking about doing those kinds of things. And then the 5th factor is use of a business office for sale, right? And so like, that comes down to, is that like, hey, are you a broker, right? Are you a broker? Do you have the licenses to do this? Do you have the permits to do this on a regular basis, right? And if you do, like, there's been times capital gain treatment has been denied and you've been subject to the dealer status, right? And so that's something else to consider, is that like, in a case, like going back to, if you are a real estate agent and you are flipping land, you're flipping houses on a pretty consistent basis, you know, where maybe you could be seen as a real estate dealer from that standpoint, right? So like, honestly, like factor 5, there's been a lot of cases where people have lost or won and did not use either. Paulus, actually, that was the one where going back, like, they actually were in the business of golf development and they actually ended up with some extra lots that they didn't need. And that's when they ended up selling those and subdividing them, right? They just like ended up realizing they didn't need them anymore. And so then they sold them to someone else and then developed them for the person they sold them to. They were viewed as those are given capital gain treatment from that standpoint, right? So they were able to win on that. And so they were able to take advantage of it. And they did use a sales office, right? But all the other cases where someone lost and they were viewed as a dealer did not use a sales office. So this factor is a little bit ambiguous. So it's like one that like, hopefully you can not count against you, but it's one that's like probably not seen as that important from the other cases. But like I said, it's like all cases technically are not as important as the others. So, and then factor 6, the character and degree of control over the representative of selling the property, right? And this one is probably one of the most confusing in my opinion. And it's that basically is that like you can conduct your business through an agent and that won't alter the fact that you're engaged in a business. However, if that agent can be used, whether or not like what your activities are, right? And so this one is like really hard to figure out like, are you using, like going back to what I mentioned before, are you using brokers? Are you using brokers for certain sales, right? Are you using brokers for some of your sales or using for some of your investment sales, right? And like, this is where that delineation can be important. It's like, hey, yeah, some of these are my flipping. Some of these are not my flipping, right? Some of these are, I'm just holding for a long-term appreciation, rental income. I want to get that appreciation over a long period of time. So I'm going to use, this guy's good at getting deals done quick, right? This guy's really good at getting me the best deal. And I want the best deal on this property because I've held it for a long time, right? I'm not just looking for the quick gain so I can then get working on the next renovation or something like that. So there's just something to consider there as well. And like, it actually brings me to a point is that like, hey, it's like those of you who are holding, like maybe you've got a single member LLC and you've got your flips in one, you got your investments in another property, right? You're holding them within the same entity. separate those, right? Let's get those separated, because now you're leaving yourself to the IRS to make that determination for you. And that's, I don't want the IRS ever determining anything for me. So imagine you don't want the same happening for you. This is an area where I'd recommend, hey, maybe you should have two different entities and have one, hey, my flipping income is going to sit over here. Maybe that makes sense for you to be an S corp. Maybe it doesn't. That's something else you should consider. But having a single member LLC that is not an S corporation or a partnership, whatever your structure is, that holds your investments and then holds your flips, right? So that way, if maybe you are a dealer, because this is the key here, right? And this is something that maybe we haven't touched on quite a bit, is that you can have investment properties and you can have flipping properties, right? So if you are a flipper, you are not going to 100% be considered to be a flipper. Some of your sales can be investment sales, right? Some of your sales can be investment sales. Some of your sales will be flipping sales, right? It just depends on your intent. And that's why we're going through these factors so you can help yourself figure out what's going to be what, right? So that way you can kind of decipher and see how important some of these things are going to be, right? Going back to what we were talking about, like let's talk like Winthrop, right? Like Winthrop didn't enlist the aid of any brokers when it comes to factor 6, which was the character and degree over, you can control over the representative of selling your property, right? Well, I mean, like the taxpayer didn't, like in Winthrop, they didn't enlist any brokers, but they were a real estate agent. They were a broker themselves. So like, it's like, how important is that? And then in Paulus, like back to the golf course one, like they also didn't enlist the aid of any brokers. It just depends, right? And so it depends on who are you doing? And this, like I said, this one is probably one of the more confusing factors. So it just depends, right? So we have to like definitely like look and analyze and see what the situation is.
Yeah. So Nathan brought up some good points I just want to bring home to us. So number one, you can be a flipper that also owns real estate investments, right? You can kind of simultaneously be both. It's not that, hey, I've got this dealer status and automatically any sale you have is always going to be considered a flip. So we want to kind of make sure people are hearing that, because you might say, hey, I've got dealer status. That kind of sounds like real estate professional status, right? It's basically what I've been deemed with, like kind of for a specific year or years to come or something like that. You can have both. These factors that we're talking about is going to simultaneously evaluate kind of the actual property itself, right? That's what we're talking about. But also as well, like who are you as far as like a business owner, right? So there is like a broader picture look, but then there is also a look at specifically what about this property, right? What was your intent in buying this property? And then the other thing I was just going to bring home too, you will hear from, all of these factors from Winthrop, nothing has anything to do with entity structure. Okay. So I just want people to also know though that having the separation could potentially provide additional clarity to the IRS. Hey, look, whenever I put a property into this LLC, the intent is for flipping. Whenever I put a property into this, call it a holding company, I always am expecting, and the intent here is for rental properties, right? So it's not a specific factor that we're going to call out as far as like, oh, they looked at entity structuring. As far as I'm aware, Nathan, and you can correct me. But at the end of the day, it's just another piece of how you can structure things on the front end to potentially help you win as far as separating which things are flips and which things are rental properties. So just want to chime in there on those things. But yeah, feel free to hit us with number 7 for the Winthrop factors.
Yeah, here's our last and final Winthrop factor, and thank you for that, Ryan, is time and effort the taxpayer devoted to sales, right? Like I said, is that if you're putting a lot of effort into this, you're putting a lot of time, a lot of effort devoted to these sales, you're trying hard to get them done personally, right? You're not soliciting other agents to come and take care of the property. You yourself are going out and you're trying to get these things sold. It's probably going to be seen as inventory, right? Like you're probably going to be seen as a dealer from that standpoint if you're trying hard to get this property. And I understand, like sometimes we have investment properties for a long time and then like we do try hard because we're like, hey, look, I need to get rid of this property. It's bleeding cash for me right now. I need to get out from under it. That's not necessarily going to mean that like you're going to be a dealer, right? So like once again, like these facts, like Ryan was just saying that like just hitting one of these factors does not mean you are trapped forever with dealer status, right? Just because on one property you were a dealer does not mean the next property you're going to be a dealer. Now, if you continue on with that, you might be viewed as a dealer, but just because, like Ryan is saying, you can have the investment and you can have dealer properties, right? But again, if you are doing a lot of this advocation for yourself, there's a good chance that you could be seen as a dealer, right? So going back to like Winthrop, let's like Winthrop, he was a civil engineer, right? He also had his real estate license and he did not do a lot of sales, but he was still viewed as a real estate dealer in that case, right? Byram, right? Byram was one where the taxpayer won and was able to have capital gain treatment. However, he devoted very minimal time and effort to the sales. He was not involved with it very much. And so honestly, like a lot of the deals were coming to him. He didn't have to do a whole lot. And then Paulus, right? That was one of the golf court cases we keep coming back to, was the court found that like, hey, you were mostly in the business of developing a golf course. You weren't really in the business of real estate. So you're not a dealer, right? It's like you have these lots. The main purpose was for a golf course. And now you've actually, no big deal. Like you just have these extra ones, like cool investment property now. And so you're going to develop them for somebody else. Right. And so and those are like situations that like, once again, is that like, as you might have seen, is that like, hey, like Winthrop, for example, had a lot of these factors on his side, but because he had continuous and substantial and his intent was to sell and develop these kinds of properties and flip them pretty quickly, he got nailed with dealer treatment. And so like the key here is that like get as many as you can on your side and hope you get some of the larger ones on your side. And that's when a tax planner and tax preparer can help you out with that, right? It's like we can help you with figuring out these factors, because even though you might have some on your side, you might not have others. And so that way is like the muddier it gets, the more ability we can have to help plan and show intention of those kinds of things, right?
As we've kind of now gone through the 7 factors, again, from Winthrop, a very old case, and Winthrop lost. As far as I'm aware, Nathan, just correct me, I think that was true, that he lost and he was nailed with the dealer status, which was unfortunate. But as people who are listening right now, right, at the end of the day, it comes down to these factors, but supporting that with documentation, right?
Mm-hmm.
If anything ever goes to an IRS agent, IRS agent's going to say, hey, nope, here's the condemnation to you, or here's the thing that we think is true. If you're going to argue that, right, eventually you're going to get to a tax court case. And that's why we're going through things like Winthrop. They all ended up there, right? But what things can listeners be doing if they're kind of in this muddy waters? What documentation might they need? What can be helpful, or what might be kind of a detriment to them in supporting not being that dealer status? What can we do?
Yeah. So one example, honestly, is the classification on your tax return. If you file a partnership tax return, if you look on, hopefully you all look at your tax returns and review your tax returns. But so there's a Schedule L. It's going to be page 5 of 1065, I believe. At least it was last time I checked. So there's an investment bucket, right? So there's an inventory bucket and there's an investment bucket. And if this is truly an investment property and you want this to be an investment property, the tax courts will go back and look at your prior tax returns and see, how did you previously classify this? There's a court case we'll talk a little bit more in a little bit called Musselwhite, where a real estate attorney had some land. He had it in an investment bucket for a long period of time on his tax return, on his investment tax return, his partnership. And then later on in the years, he flipped it to inventory, right? And so now he wanted to get ordinary loss. And then the tax court decided he was going to get capital loss because they looked back at that treatment, right? So doing those kinds of things, showing your intention, maybe writing in documentation what you are wanting to do on said date, right? And have that documented, have the metadata of the Word document actually match the date that you created it, right? So like the tax courts have looked at that and seen like, hey, did you just make this right before you walked in here? Or did you actually create it on the date that you said you would, right? So something to think about there is having that kind of documentation, having a plan, right? If you have a plan of like, hey, we want to hold this property for probably 4 to 5 years. We're going to see what the appreciation is at that point in time. And then we'll think about like, make a decision, right? Like we think this is a good area. Maybe we can get some good lease. Maybe we can lease this to some people in the time, get some good cash flow while we let the property appreciate. And so almost no one holds a property for life, right? I don't think I've never seen a real estate dealer, besides maybe some of the older folk that we talk with, who have held these properties for forever and ever and ever. Most of the time you're going to make it sell at some point in time, which, like we've said multiple times, that is okay. So having plans, having written documentation of said plans, and just like having classifications on tax returns, those can be good fact patterns for us and help lend towards the investor treatment instead of the dealer treatment.
Yeah, that's really good. So to summarize that, prior year tax returns, right? Well, we can talk about Musselwhite here in a second. I just want one more comment on that. But also maybe like a document kind of talking about your intent, right? What's my plan here? What am I going to do? Maybe that's an email to a business partner or just for yourself, just kind of outlining what that is. But those are 2 things to be considering. And just to comment too on something Nathan said. So the treatment originally for Musselwhite was that they had it as a investment, okay? Which means initially we're starting to think, okay, this is going to be capital, right? Capital property. And then they switched it to an inventory, which now would start to indicate, oh, now that's becoming under that dealer status. And when we sell it, it's going to get to that 52 point whatever percent, right? And so the unique thing for Musselwhite that I just want to help people understand is that he actually had a loss. Okay. Sounds like a really substantial loss, like $1 million or something, right, Nathan? So $1 million, a loss. So what is more beneficial for him? It is more beneficial actually that he claims effectively that dealer status, because now that $1 million of loss can now be considered ordinary and actually offset things like his real estate attorney income, right? So that was more beneficial. So what does he do? Last minute or the last year, he moves its inventory. Well, the court looks back and says, hey, your intent was that it was capital. So now the court comes back and says, hey, we see what your intent was. We're changing that back to be capital. And so now, because that's a capital loss, we all know that capital losses can only be at a maximum taken in a year up to $3,000 of losses. So it was actually detrimental to him in order for that to be switched, which makes sense why he would actually want that to be ordinary. So I just want to kind of draw that out as far as like, you've got effectively the IRS looking at these things to say, hey, you've got a gain. We know that it's more beneficial for you to have that as capital, or you've got a loss. We know that it's more beneficial for you to have that as ordinary, right? So they're thinking about both sides, whether it's an income and loss. But Nathan, kind of with that, like where are we at today as far as what you and I were talking about before the episode is kind of this whipsaw treatment. Kind of talk to us about what's going on there and what's going on more recently in these court cases.
Yeah, fantastic breakdown of Musselwhite on nothing. There's literally nothing for me to comment on that. But so more recent years. So Musselwhite was a 2022 case. And so right now, honestly, in the past, I would say 10 years, the past decade, the IRS has combated anyone who has, like Ryan was just saying, like you want capital gain in a property, right? Well, they're going to say it's actually ordinary income. They're going to try and classify you as a dealer. And in Musselwhite's example, where you have a substantial loss on a property, right? He purchased property right before the housing crisis in 2008. And so therefore, what he paid for it in 2006 was no longer worth the value later on years when he wanted to get rid of it, right? When he wanted to sell it. So then he tried to play the game. Well, I want an ordinary loss in this property. I have millions of dollars in attorney income. I'm a partner of a firm. I want this offset. So why not just sell this property, get what I get, right? I don't care what it goes for. I just want tax loss at this point in time. It's going to be more beneficial for me to get a tax loss. Well, the IRS goes, hold on there. That's beneficial for you. That's not beneficial for us. So we're going to flip that treatment. And so what's been happening in the past decade is this whipsaw treatment of like, hey, you want to get capital gain treatment or you want to get ordinary loss treatment? Well, the IRS is going to combat you on whichever side you don't want to be on. And honestly, more frequently, they've won more than they've lost. So in Allen, for example, right, we talked a lot about the frequent and continuous sales factor, right? Hey, that's like if you've never made a sale before. And like, I'm not saying this to alarm people, but I just want to like bring it up. Like this needs to be discussed because this is a 2014 tax case So Allen, for example, he was a civil engineer. He worked for a land developer, and he actually purchased some land himself. And then it ended up being a bad deal, and he wanted to get out from underneath it. And so he sold it, right? He sold it for a gain. He classified it as capital. IRS came and said, no, that's ordinary. We think you're a dealer. And he said, I've never had sales before. This is the most important factor. I've never sold anything before. I never sold real estate before. This is the only time I've ever sold real estate. I think I hate selling real estate because it went so poorly for me. I did not like it. The court found that didn't matter. That previous substantial sales didn't matter whatsoever. And so he is like, there's not a quote unquote one bite rule. Like basically it's like once you've done it once, now you're tainted forever. Basically it's like, hey, yeah, nope. We think that in this scenario, even though you've never done sales before, that you are seen as a real estate dealer. And he had ordinary income, right? And on the flip side, there's another tax court case called Evans, right? Where Evans is like in a similar year where he won an ordinary loss, right? He had bad deals in some properties, went for sale and foreclosure, and he had done flips before, right? He couldn't really, he said he'd done 8 or 9. He unfortunately didn't have records. So there's another fact pattern. Like Ryan was saying before, have records, have documentation of these things, and you'll be able to you'll be able to prove more out when you have more facts on your side. But he was not able to prove out that he was a dealer and this investment was one of his dealer properties, even though he had done this before. The IRS said, no, this was an investment property for you. Therefore, the loss you're going to get is going to be limited to $3,000. And the tax court ended up against him on the IRS's side. So right now, there's a lot of whipsawing going on in tax court, right? And so whether or not we're going to see some of these types of cases go up to higher courts, right? Like the Fifth Circuit, the Sixth Circuit, right? Those upper appellate courts, those district courts. We'll have to wait and see on how these get decided. As of right now, I don't know of any that are being debated, but we'll have to wait and see if these get overturned or if they are the current law. Because right now, current law, it looks like you could get into some really bad treatment. You get stuck, not with bad treatment, with dealer treatment, in a scenario where the IRS is able to fight against you, right?
Yeah. You've got to be careful out there if you're going to have even just one sale, right? I think that goes to the Allen case where it's just literally the first sale or one sale. So it's not like, oh, I've never done this before, therefore it's I'm in the clear. Or like some people might be listening and saying like, oh, my first one, I'll be clear, to get away with the capital gain treatment. It's really going to come down to more than that. And so people need to be evaluating and be careful. You actually might have an idea of what's going on here, but if you don't have support, documentation, the facts, the circumstances don't align there, just know that it's going to cause some suspicion and you're going to need to have support for yourself to do that. And it seems like right now, Nathan, you and I were talking beforehand, it's like the goal of the IRS is for you to lose, which makes sense, right? They're there to basically enforce the law and to try to earn more revenue in the form of taxes by going after people they think are good targets. So as we kind of wrap up today, I think this has been a fantastic episode. We haven't touched on this in quite a while, but if you were to just kind of give a final comment to people listening, hey, I've got a sale of a property coming up, or I'm thinking about doing flipping or whatever, what would be like, hey, if I could say one thing to these listeners to kind of summarize all of this, what would be like your comment and recommendation to them?
Yeah. So I would say is that like, it depends, right? No, I'm kidding. Essentially, you're going to need to have a plan. You're going to need to have some kind of documentation of your intent, right? When you purchase this property, the reason why you want to have it. And if later down the road, your mind changes, right? You want to hold it for appreciation, but now you're selling it. Why? Why are you selling it? What are the reasons behind you doing this? Why did it change from what you said it originally was? If you can back that up, it's going to be a good fact pattern for you, right? And if you can have delineation between what is investment and what isn't investment, right? That's also going to be helpful for us because then we're going to be able to have documentation. And let's say IRS audit ever did appear, or you did go before tax court. You can show them visibly and physically the reasons why you did what you did. That's what's so key here. That's what's so key here is that like you have this and you know what? Like maybe you are going to be stuck with dealer status. If you are, then you should probably consult with an advisor and see maybe if an S corporation for your sales is worthwhile, right? Like there's a lot of savings that we have a lot of clients who are involved in flipping and wholesaling who take great tax benefits from being an S corporation. Now that doesn't always work for everybody. And maybe it doesn't work for in your first year. Maybe it is your first few sales. And again, there's a lot of opportunity here. It's just going to be whether or not you can prove out why you're doing what you're doing and you can show your intent and whether or not you can have these fact patterns on your side.
Yep. And just one other comment I'll add in. You can't just simply take your tax return and put everything that is really inventory into investments or anything like that. And you can't simply just have all of your documents for every purchase say, hey, my intent is to hold this and be a capital asset. Like that's not going to work. But what we're trying to just instill is that documentation is going to help support if the other facts and circumstances point to that. You can't just make stuff up, right? The IRS is going to sniff those things out and they're going to bring that to light and say, hey, this doesn't make sense. This doesn't align with what you actually did because you actually turned around and subdivided this and blah, blah, blah. And so everything needs to align, right? But this additional support, this documentation is going to give you that additional help to really show intent and things like that. So I just wanted to comment on that as we kind of wrap up today's episode. But Nathan, where can people find out more about you and kind of what you're doing?
Yeah, if you guys are interested in learning more about tax, give me a follow on LinkedIn, give me a follow on X, Twitter, Twix, whatever we call it now. Also check out our blog. We've got some blog posts on there that I've written, so 100% want to check those out. Definitely can find us, and if you want to keep working with us at the Real Estate CPA, we've got a link, and you just click on and you can come talk with our team.
Awesome. Yeah, it's so funny. We don't know, do we say X or do we say Twitter? I feel like everyone still says X, Twitter. So I get that. But yeah, Nathan's posting on Twitter, X, whatever you want to call it.
Wix, right?
Yeah, and he's also posting on LinkedIn. So if you're interested in more of these things and additional topics, Nathan's putting out content. I'm putting out content. We as a firm are putting out things like this. And last comment I'll make just before we wrap up, if you are a listener and you are a real estate investor looking for a CPA tax strategist, we are are taking on new clients. We always are. Feel free to reach out to us. You'll see a link in the show notes. Click on that, fill out the form. It'll take you 2 minutes. Give us some basic information about you, and we will reach out to see if we are a good mutual fit. But the second thing I'll say too, if you are a CPA, you're not maybe a potential client, but you like our podcast, you like what we're doing, you like what you hear and kind of the people you might be working with, like me and Nathan, reach out to us. We're looking always to hire good CPAs as well, EAs, as far as tax prep, tax strategy, things like that. So reach out as well if you're a CPA looking for maybe a change in your career. So with that, we'll wrap it up. And Nathan, thank you for walking through all the dealer status, the Winthrop factors, all of that. And we'll catch you around, and thank you everyone for joining us.